Right now, gold in Shanghai trades $120 more per ounce than in London or New York. That's not a typo. That's $48,000 for a standard delivery bar. And nobody can arbitrage it. Think about that. Algorithms that chase millisecond edges across global markets and a spread that has persisted for months, sometimes years. If you could buy in London and sell in Shanghai, you'd be printing money. But you can't. The door is locked. In 2020, a NASDAQ-listed company used 83 tons of fake gold, copper bars painted gold, to secure billions in loans from major Chinese lenders. Insurers refused to pay, regulators stayed quiet, and a single question echoed through the market. If that was 4% of China's reported reserves, what else might be fake? Stay with me. The premium in Shanghai is the visible symptom, but the real story lives underneath, in 3 overlapping layers that drive prices, block arbitrage, and shape what that premium means for your money. Nobody agrees on what's happening. Some say Shanghai exposes Western price suppression, that COMEX and the LBMA are paper markets built on contracts that will never deliver. Others call it simple capital controls. China is a closed system, and citizens are forced to overpay. Then there are the theories that Beijing is hoarding gold to back a new currency. And, quietly, forensic accountants, still burned by Kingold, ask a different, darker question. Is the gold even real? They can't all be right, but they are all using the same numbers: SGE withdrawal reports, import quotas, premium spikes, historical vault statements, and drawing 4 very different conclusions. That mismatch isn't just confusing, it's dangerous. If you hold gold, or plan to, you need to understand the plumbing beneath the headlines. Start with the number that drives everything, the Shanghai premium. Throughout late 2023 and much of 2024, Shanghai traded $50 to $120 above London spot. A 400-ounce London good delivery bar might cost roughly $800,000. In Shanghai, add $48,000 per bar. In a normal market, that spread disappears in seconds. Arbitrageurs buy low, ship, sell high. Free money. But the People's Bank of China controls imports through licensed banks. When the yuan weakens, and it has, import quotas stop. No quota, no imports. Supply is locked out. Domestic demand climbs as citizens flee property and currency risk. Classic supply shock. Here's the contrarian twist. This isn't China breaking free of Western manipulation. This is China trapping its own citizens. The premium functions like a tax on savers who can't access international prices. They're forced to pay above market rates because capital controls prevent them from buying abroad and bringing metal back. Look at withdrawals. In January 2024, the SGE recorded 271 tons withdrawn, 1 month. For context, global mine production runs roughly 300 tons a month. In April 2025, another 153 tons. Those spikes correlate with premium surges. When Shanghai prices jump, domestic buyers panic buy. It's not always strategic accumulation, it's fear-driven hoarding. Contrast that with COMEX warehouse stocks in New York, largely stable, between 8 and 10 million ounces. If China were systematically cornering global supply, you'd see COMEX inventories collapse and London premiums climb to match Shanghai. You don't. What you see is a closed domestic market operating under crisis psychology, while international markets function normally. And then there is Kingold. In 2020, Kingold Jewelry, NASDAQ ticker KGJI, pledged 83 tons of fake gold as collateral. These weren't tungsten cores with telltale density. They were copper alloy bars with gold plating. Someone along the inspection chain either failed to do their job or was paid not to. At the time, 83 tons represented roughly 4% of China's reported reserves. If a single company could pass copper off as gold through multiple institutional layers, what credibility do vault reports hold?
Even the suspicion that inventories might be compromised pushes buyers to pay a premium for verified physical delivery. The premium becomes a fraud insurance tax. Consider import quotas as a weapon. China imported roughly 1,000 tons in 2023. In 2024, imports dropped by about 30%. Not because demand fell, demand surged as premiums show. The People's Bank of China simply stopped issuing import licenses when the yuan weakened. Gold imports required dollar payments, so to defend the currency, authorities restrict those dollar outflows. The result? Artificial scarcity, domestic price spikes, and a premium that acts like a pressure relief valve, making gold too expensive for many citizens and cooling demand without admitting currency stress. Now, the paper versus physical argument. COMEX futures often show open interest around 450,000 contracts, each contract 100 ounces, about 45 million ounces of paper exposure. COMEX warehouse stocks are much smaller, roughly 10 million ounces. Gold bugs point to that ratio and call it fractional reserve. But the mechanics matter. Most futures, 98%, are cash settled. Traders speculate on price. They don't intend to take delivery. The LBMA is an over-the-counter market with allocated and unallocated accounts, different risk profiles. Shanghai requires physical settlement. You can't paper trade your way out of delivery there. That requirement is not purely a virtue. It's a constraint. Shanghai can't easily absorb large speculative flows. Liquidity is lower. The market is more vulnerable to panics and manipulation by concentrated buyers. In a closed system with import restrictions, a concentrated buyer can control price. Who benefits? Not retail, not foreign investors. The players with import licenses and political access.
Look at global volumes. The LBMA clears roughly 20 million ounces per day. The Shanghai Gold Exchange trades about 300,000 ounces daily. That's a 60-to-1 difference in liquidity. Withdrawals measure hoarding. Volume measures market depth. Shanghai's withdrawals may be headline-making, but they don't equal global market depth. If Shanghai were becoming the global price setter, you'd see LBMA volume migrate east, refineries prioritize Shanghai deliverable bars, and systematic arbitrage. You don't, because capital controls block it, and those who can access the premium, licensed banks, have no incentive to close the gap. Why now? China's property sector is in controlled demolition. Evergrande collapsed, Country Garden restructured, household wealth tied to real estate is eroding, equity markets have underperformed, local government debts and trust products are showing cracks. When property, stocks, bonds, and trust products all fail, where do people park money? In hard assets. Physical gold in a vault they control. It's not a bet on higher gold prices, it's a bet on everything else falling. Everything else. Because capital controls make offshore escape difficult, citizens are trapped in domestic assets. A simultaneous rush into the one hard asset the state cannot instantly devalue creates the Shanghai premium. The scam is not the premium itself. The scam is a system that eliminates alternatives and then profits from the panic buying that follows. The premium, then, is not a single problem. It's three colliding systems. First, currency defense. When the yuan weakens, import quotas tighten. That's standard in emerging markets. China's twist is using gold restrictions as a monetary tool disguised as supply management. Every quota cut signals currency stress without admitting it. Smart traders read the premium as a yuan weakness indicator and act accordingly. Second, institutional capture. Import licenses are held by a small group, state banks, and politically connected firms. If you were one of a dozen importers, buying in London and selling domestically at spot plus $80 is profitable. Why flood the market and eliminate your margin? The structure ensures the spread persists. Third, credibility crisis. Kingold showed institutional oversight can fail spectacularly. Once trust breaks, every premium spike carries an extra question. Is this genuine demand or is it doubt priced in? Official reserve numbers, reported as over 2,000 tons, are self-reported and unaudited. If even a fraction were questionable, the implications are large. Layer on global liquidity contraction, U.S. tightening, stagnation in Europe, Japan's currency moves. Every central bank wants hard assets. But if you're China with a credibility problem and capital flight risks, you can't buy openly in London. That signals weakness. So you let a domestic market exist, close the borders, let premiums spike, and absorb supply through state banks that appear private. The premium becomes a revenue stream and a veil. What happens next? There are three plausible paths. A base case, most likely, sees the premium persist in a range. The yuan stabilizes but doesn't strengthen. Property pain continues. Quotas stay constrained. Licensed importers profit. Chinese retail pays the cost. A bullish stress case would send premiums above $150 if property collapses trigger bank runs and mass flight to physical gold. A bearish path collapses the premium if China opens import quotas or demand evaporates after another credibility shock. Timing matters more than direction. If you were buying gold as a long-term wealth protector, the premium is noise. You want liquidity and recognized deliverability. If you trade on the thesis that Shanghai will break COMEX, you are betting on transparency, coordination, and free capital flows, none of which exist. For anyone watching closely, track the import quota and withdrawal data. If monthly imports fall below critical thresholds for consecutive months, that's an early warning of severe currency defense. As a foreign buyer, treat Shanghai prices as irrelevant to your strategy. Focus on spot prices, recognized deliverability, London good delivery bars, or widely accepted sovereign coins. If you need liquidity in the next year, avoid holding illiquid physical bars in a panic. Use allocated accounts or physically backed ETFs that offer tradability. If you can hold long-term, secure storage matters. Private vaults, not an uncertain bank deposit. If gold surges above certain levels while Shanghai premiums collapse, read that as either a resolution or a market shutdown. Both break momentum. Positioning for the cycle is about survival, not spectacle. Preserve a defensive allocation, some physical or allocated gold for protection, short-duration treasuries for liquidity, diversified equities with limited China exposure, and cash equivalents. Avoid concentrated bets on Chinese property, yuan-denominated debt, or speculative plays that assume the Chinese capital account will miraculously open. The market is not a single scam. It's a layered phenomenon, currency defense, institutional capture, and a credibility crisis that together produce a premium that benefits insiders and penalizes ordinary savers. Understand the plumbing and you see who profits when the headlines talk about the market. That's the point. Prices are signals, but signals can be engineered. When the canal locks are closed, the water level on one side rises. That doesn't mean the ocean is changed, only that the gate is shut. If you want to survive the next cycle, focus on liquidity, verified physical deliverability, and the institutional incentives behind price formation. Because once you understand the system, you see who is really getting scammed.